Hey everyone, welcome back to the channel, and if you're new here, thanks so much for stopping by. Today we're diving into something that's been on a lot of people's minds lately, and that's gold investing. Now, I know what you might be thinking. Gold. Isn't that what your grandparents kept in a safe somewhere? Well, yes and no. Gold has been a store of value for literally thousands of years, and in 2026, it's actually more accessible than ever before for regular people like you and me to invest in it. So whether you're looking to diversify your portfolio, hedge against inflation, or just want to understand what all the fuss is about, stick around because I'm going to break down everything you need to know to get started. First things first, let's talk about why gold even matters. Unlike stocks or crypto, gold is what we call a tangible asset. It exists in the physical world. You can hold it, store it, and most importantly, it has maintained value across centuries and civilizations. When paper currencies have failed, when empires have fallen, gold has remained valuable. That's pretty powerful when you think about it. In our modern economy, gold often acts as a safety net. When stock markets get volatile or when there's economic uncertainty, people flock to gold. It's like the comfort food of investing. And with everything happening in the world right now, from geopolitical tensions to concerns about inflation, gold is having quite a moment. But here's where it gets interesting. You don't actually need to buy physical gold bars and store them in a vault to invest in gold anymore. In fact, there are several different ways to get exposure to gold, and each method has its own pros and cons. Let's start with the most obvious one, physical gold. This means buying actual gold coins, bars, or bullion. There's something undeniably satisfying about holding a gold coin in your hand and knowing that you own it outright. Popular options include American gold eagles, Canadian gold maple leafs, or gold bars from reputable refiners. The advantage here is that you have complete control over your investment. No one can hack it. No company can go bankrupt and take your gold with it. It's yours, period. However, physical gold comes with some challenges. You need to store it safely, either in a home safe or a bank safety deposit box, and that costs money. You might also want to insure it, which is another expense. Plus, when you're ready to sell, you'll need to find a reputable buyer, and the transaction cost can be higher than other investment methods. And let's be honest, if you need to liquidate your investment quickly, selling physical gold isn't as instant as clicking a button on your phone. But for many people, these trade-offs are worth it for the peace of mind of owning something real and tangible. Now, if you want the benefits of gold without the hassle of storage, you might want to look into gold ETFs, which stands for exchange-traded funds. These are basically funds that track the price of gold, and they trade on stock exchanges just like regular stocks. The most popular one is called GLD, but there are others like IU. When you buy shares of a gold ETF, you're essentially buying a piece of a large pool of gold that the fund holds. The beauty of ETFs is their convenience. You can buy and sell them instantly during market hours through any brokerage account. There are no storage concerns, no insurance to worry about, and the fees are generally pretty low, usually less than 0.5% per year. The downside is that you don't actually own physical gold. You own shares in a fund that owns gold. For most people, this distinction doesn't matter much. But if you're someone who really values that tangible ownership or you're worried about extreme economic scenarios, this might not give you the same sense of security as having gold coins in a safe. Another option that's becoming increasingly popular is gold mining stocks. Instead of investing in gold itself, you're investing in the companies that extract gold from the ground. When gold prices go up, mining companies often see their profits soar because their costs stay relatively stable while the value of what they're selling increases. This means mining stocks can potentially give you leveraged exposure to gold price movements. Companies like Newmont Corporation, Barrick Gold, or smaller junior miners can be part of a gold investment strategy. But remember, when you invest in mining stocks, you're taking on additional risks beyond just gold prices. You're betting on management decisions, operational efficiency, environmental factors, and all the usual risks that come with investing in individual companies. Some people like to balance their gold investment portfolio by combining physical gold or gold ETFs with a smaller allocation to mining stocks for that growth potential. There's also something called gold mutual funds, which are similar to ETFs, but with some key differences. Mutual funds are actively managed, meaning a fund manager is making decisions about what to buy and sell, whereas most gold ETFs passively track the price of gold. Mutual funds typically have higher fees because of this active management, but some investors prefer having professional management, especially with gold mining mutual funds where picking the right companies requires expertise. For those of you who are more digitally inclined, there are even digital gold platforms now where you can buy gold online and have it stored in secure vaults on your behalf. Companies offer fractional gold ownership, meaning you can invest with as little as a few dollars. These platforms handle all the storage and security, and you can buy or sell with just a few clicks on your phone. It's like the best of both worlds in many ways, combining the backing of physical gold with the convenience of digital investing. So how much should you actually invest in gold? Financial advisors traditionally recommend keeping somewhere between 5 and 10% of your portfolio in gold as a hedge and diversification tool. The idea isn't to get rich quick from gold, but to have something that tends to hold its value when other investments might be struggling. Gold isn't typically a high-growth investment. It doesn't pay dividends like stocks or interest like bonds. Its value comes from being a store of wealth and a hedge against uncertainty. If you're just starting out, my suggestion would be to start small and learn as you go. Maybe begin with a gold ETF if you want simplicity, or buy a few gold coins if you prefer the tangible experience. Watch how gold prices move in relation to other markets. Pay attention to what drives gold prices up and down, things like interest rates, inflation data, currency movements, and global events. The more you understand these dynamics, the better investor you'll become. And remember, gold is a long-term hold for most investors. Don't panic sell when prices dip, and don't get overly excited and overcommit when prices are soaring. The bottom line is that gold investing in 2026 is more accessible than ever, with options ranging from physical coins to digital platforms. It's not about choosing one perfect method, but finding what fits your financial goals, risk tolerance, and personal preferences. Whether you're looking for financial security, portfolio diversification, or just want to own something that's been valued for millennia, gold can play a meaningful role in your investment journey. Thanks so much for watching, and if you found this helpful, give it a thumbs up and let me know in the comments which gold investment method you're most interested in trying. See you in the next one.